operations, its history, its market psychology, its understanding, how the world moves. It is incredibly difficult to beat the market. So the idea behind hedge funds was that they'll have an investment portfolio that is less subject to market swings and should outperform the market. That's what investors are looking for, and that's what managers are trying to deliver.
Hedge funds have ways to cash in if the stock goes up, down, or even sideways. They do this by pulling together money from investors. Not small potato investors, but high net worth individuals. And then hedge fund managers will find creative ways to invest that money. One of these strategies is called short selling.
Short selling is a bet that a security is going to go down. Say you own a share of IBM. Okay, hey, can I borrow that share? Say, sure, I don't need it right now. I'm not planning on selling it, so I take it, I sell it for $10. Let's say the stock goes down 20% next month, and it's now at $8. Okay, I buy it back at $8, give you your share back. You're in the same place you would have been either way. You have your share of IBM, but I made $2. And that's how short selling works.
Now take that $2 and slap a whole lot of zeros on the end. Now we're talking. That's the kind of money a hedge fund can make when they short shares of a dying stock.
Shorting is just a way of saying we think that the stock price will go down, and we're going to bet that the stock price goes down. That tells you that that stock's in trouble. Usually they're right.
What happens then is that the company can't get any more capital and becomes insolvent. Then it will be a self-fulfilling prophecy. The fact that it's done by hedge funds, who tend to be really wealthy, kind of looks like a cartoon villain.
But there's one big catch to shorting. If the price suddenly starts to go up, then hedge funds could take a hit and lose a yacht load of money.
If we buy a stock at $50, we know that if the stock goes to zero, how much can I lose? $50. If I short a stock, the stock can go up to infinity. I can actually lose more money than I placed in that bet.
So it can be picking up nipping in front of the freight train, and it sort of works until you get run over.
So a lot of times what they'll do is they'll find a really big struggling company, like Toys R Us, for instance.
Toys R Us has filed for bankruptcy. The retailer is reportedly about $5 billion in debt.
So they're like, we know this company's about to go under, so we're just going to short the ever-living shit out of it. So no investor's going to come in and try to save it anymore.
Whose idea was that? Whose brand?
I can't take my kid.